Hey you guys, welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. A lot of people have been panicky lately because the market has gone down. And if you've been investing more than a week, you know that the stock market does in fact go up and down. It doesn't always go up. Although after a very, very long run of more than a decade, we've had a big bull market, and now it seems like we're finally seeing some decline. Back in January, we actually hit what they call a correction, which means the market drops more than 10%. These are pretty common. They happen once a year, once every other year at least. When you get to 20%, it becomes what they call a bear market. So I thought I would take a look real quick at how we're doing so far this year. And first one, you guys know my favorite to use is the S&P 500 because I feel 500 stocks, all different industries. It's a good index to use as a general thing, and most people have some sort of S&P 500 index fund in their retirement plan, so it's pretty easy to find. So if we look at year to date here, we see that we started just below 4,800 in January. Right now we are down to 4,297, so under 4,300. You guys, we're down right at 500 points this year for a total of about 10.41%. It's easy to get down when you see big numbers like that and you see the indexes dropping and your balance is going down. Even more so than that, let's take a look at the NASDAQ. The NASDAQ started out the year at 15,832. It is down all the way right now to 13,325. You guys, it's down 2,500 points. Now, the point systems are a little different, but to give that a percentage, it's down 15.84%, almost 16%, you guys, year to date. Remember, the NASDAQ is made up mainly of tech stocks. And a lot of these big tech stocks also make up a big portion of the S&P 500. So they don't always go exactly in conjunction, but a lot of the bigger tech companies, Apple, Tesla, Google, are in both indexes. And obviously, if one's going down, they're both going down some. So anyway, I found this article here real quick. I wanted to take a look at it. It says, the NASDAQ composite is nearing its first bear market in nearly 2 years. Here's the level to watch. And this is dated February 23rd of this year, written by Mark DeCambray. This is from marketwatch.com, you guys. A close at or below 12,845.95 would meet the most commonly used definition of a bear market. I want to keep what I have. I don't have 20 more years to grow. Now, obviously, I do have a lot of stocks still, and they will grow over time. But as I get closer to my retirement, I start thinking a little bit differently than somebody who has, say, a 20-year horizon before they're worried about taking the money out. I will eventually be needing to draw from my accounts within the next few years. So let's read on. Higher yields have been blamed for the sell-off by many tech and other so-called growth stocks whose lofty valuations were based on profit and cash flow expected far in the future. Higher yields mean the present value of those future flows are worth less. Meanwhile, tensions in Eastern Europe could threaten to drive inflation even higher and provide further cause for monetary policymakers to raise borrowing costs to cool the economy if the price for commodities, including everything from wheat to crude oil, continue to go higher. So once again, remember, things that happen elsewhere in the world do affect us, and things that happen not only in the business world, but things that happen in other parts of the economy directly affect how the stock market reacts. And the stock market likes everything hunky-dory. When things get out of whack, when things get unsure, the stock market gets a little jittery, and that causes prices to go up and down, and you get volatility. You guys, we're not in a bear market yet. We're just in a correction. And as I said, these happen every year, every couple of years. You're going to see your market, you're going to see your value go up and down. Expect that. If you're somebody who's going to panic because, oh my gosh, we lost 15%, it's going to be a long road for you. Learn to embrace the fact that it is usually, even recessions usually recover themselves in 18 months. So if you have 5 to 10 years before you need that money, you're probably going to be okay. Just don't sell your stocks when they're down. If I can tell you one thing, if you guys only learned one thing from my channel, do not sell your stocks when they are down. Hold them. Now, if you have it in a retirement account, don't change anything. Leave it. If you have it in a taxable account or a brokerage account, you may want to take some of those losses and harvest them against the gains that you made in other stocks, because then you can offset your tax bill. That would be the only time. But just because it looks like the sky is falling, you guys, don't do that. Do not sell. Don't go to cash, because then you will lock in those losses. Hold on to your stocks and think long term. Remember, the easiest thing to do in investing is put it on autopilot and forget about it. That way you're investing every month, whether it's up, whether it's down, you're buying at that price. And over the long run, I think that's probably the best way. All right, guys, I hope you got something out of this. If you did, do me a favor. Drop me that like. If you're new to the channel and you're not already subscribed, you know the deal. Hit the red button, ring the bell. All right, we'll see you.